Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 12th of November. I'm Daniel Lam, your host for the podcast. We've gotten some feedback about a podcast this Monday, where we discussed the current earnings season in China. Now, specifically, there are questions on how the Chinese economy has been faring and how it would influence equities performance. So the latest key figures were the CPI and the PPI. Now, China's October inflation rebounded, with headline CPI rose to 0.2% year over year from minus 0.3% in September. PPI also improved, but stayed in contraction territory at minus 2.1% year over year. Could this be an indication that finally the inflation problem is going away? Well, the October's inflation lift was largely driven by temporary factors. Higher CPI reflected elevated gold prices, which pushed up jewelry cost, and seasonal effects such as holiday timing that boosted services prices. The PPI improvements stem from supply curbs linked to an anti-involution measures designed to reduce excessive capacity. Now, these policies boosted prices in the short term, but they stay in a deflationary cyclical path. So we believe in China, the companies that are labeled with innovation and technology self-sufficiency, i.e. the key directives of the new 5-year plan, are going to be the focus for investors. Even amongst the Hang Seng Technology Index, there will be differentiation in performances between these stocks versus the ones that are affected by excessive price competition. So in a sense, there are similarities between China and US technology companies, because investors are increasingly differentiating the performances amongst these two buckets of stocks. So in the US, the Nasdaq 100 index has been trading very close to plus 2 standard deviation versus its valuation since 2022. Investors demand full set of ticks across the boxes, i.e. earnings beat, clear visibility in future earnings, and strong guidance. Otherwise, they will be met with profit taking. Now, this is really a case of, with great expectations comes great responsibilities, i.e. the responsibility of the companies to deliver great results in order to lead to continued faith from investors. It is a fact that equities are more expensive now compared to the start of the year. The trick for investors at this moment in time is to focus upon US companies that have clear visibility and strong guidance, and Chinese companies that have demonstrated innovation and technological leadership. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.